diversified of the okay of the like assets like stock, bonds, and debentures, and other assets related to that. Though it is related to they are easily accessible to the investors and regulated by the financial market regulator like any other financial products. The units of the investment trust will be listed in the stock exchange, and investors can sell their units in the stock uh, market for the liquidation for their capital. So this is a investment trust. Next, it is a real estate developers facing the servers crash into the market due to the lack of demands for the projects are the permitted to launch the investment trust and to get their easy accesses to funds and also create a new investment avenue of the institutions and high net worth individuals. Okay, so the development of investment trust in India. First of all, not only India, the development of investment trust in the world, the investment trust are the historical popular in England, and the first time the investment trust was created by Belgium by Royal Family of Belgium in 1873. Uh, next, after that, after the World War One, the investment trust movement was started in USA during the 1960s through the Seeger Excise Tax Extension Act. Seeger Excise Tax Extension Act to promote the investment into the infrastructure and real estate and boost the growth of economy. The investors are interested to hold the investment in the real estate became members in the trust. In 1970s, Australia established the Promotional Investment Trust, and in the year 2000, countries such as Japan, South Korea, and Singapore promoted the investment trust. In India, it is developed in 2008. In India, the SEBI means Stock Exchange Board of India is promoted and established. REITs means real estate investment trust. REITs, Real Estate Investment Trust, in the year 2008 and released the draft of the regulations, but it was not implemented later 2013. The SEBI released the consultation paper on the REITs, but taxation aspects were not clearly indicated the document. That's why a delay from 2008 to 2013, this is 5 years. Next, after the 2014, the making amendments of Income Tax Act 1961 to provide the tax benefits to the REITs. These investment trust established and operations are started. So this is development of investment trust in India. In investment trust in India, after the Finance Act 2014, after amendment of the Finance Act 2014, introduced the concept of the business trust in India because trust would operate as a real estate investment trust and infrastructure investment trust, and REITs are the quite familiar in the USA form of the 1916 onwards in the many other countries around the world, Australia, Singapore, Japan, South Korea, France, UK, and are successful using the REITs for the mobilization of funds into the real estate sectors. Being India as a new segment of a REITs and BRICS countries, only China is operating without any REITs. Next, for real estate developers, it is an alternative funding mechanism for providing the liquidity and investors. It is an approach for the accessing high value of commercial properties and affordable rate and earn the steady stream for cash flow and long-term benefits. Next is the definition of the business trust as per the Income Tax Act. This is the definition of the um, business trust as per Income Tax Act 1961. Section 2, subsection 13A.
Page number, sir?
Page number 135, 135. Okay?
Okay, sir.
Right. Under 10.4 now. 10.4.
Okay.
Right. Okay. Section 2, Income Tax Act 1961, Section 2, subsection 13A of Income Tax define the business trust as the business trust means a trust registered as an infrastructure investment trust or a real estate investment trust. The units of the which are required to listed on a recognized stock exchange in accordance with the regulation made under Securities Exchange Board of India or SEBI Act 1992. Okay. Next is SEBI is affects capital market regulations. Notified these two new investment vehicles under the investment trust and SEBI. SEBI means here REITs. REITs means real estate investment funds. So this is one. Both are comes under 2014 Financial Act after amendment of the Financial Act. Next is the types of investment trust. Types of investment trust. In India, the investment trust functioning in India can broadly categorize two types. There are two types of investment trust. Number one is real estate infrastructure, real estate REITs, real estate investment in, trust. Then second one is the infrastructure investment trust. First one is real estate investment trust. Then second one is the infrastructure investment trust. What is a real estate investment trust? Real estate investment trust REITs are a new form of investment into the real estate sector, and they function exactly like a mutual fund. In case of mutual fund, the underlying the asset is either a share or a bond or a debenture or a government securities, whereas in case of REITs, the underlying the asset is a commercial properties, holding a property and developing a property in the real estate sector. This is a real estate investment sectors. Next, second one is the infrastructure investment trust. What is infrastructure investment trust? In SEBI, real estate regulation of 2014, the state and full the money will be invested in the selected properties through a trust or a special purpose vehicle. In special purpose vehicle, it is a plot rate by a 50% of equity shares or stock and in investments. And after that, as a real estate developers, all the income generated in the form of the rentals of the commercial properties, like a capital gain, by way of selling the properties, will be transferred to special purpose of vehicles or special purpose of vehicles to trust and launching a REIT fund. Developers can mobilize resources for further development or may use the funds for the repayment of debts. So this is the SEBI regulations or REITs. Next, second one, next is the taxation issues on REITs, real estate investment trusts. As per the Income Tax Act 1961, REITs are structure of a flow through by hybrid pass-through entries. Hybrid pass-through entry. This structure is created in order avoid the double taxation in the purpose of income tax hands of the investors. But the treatment of income tax distribution to unit holders or real estate investment trusts is the same. But it is like a dividend and the income distributed investors the same dividend of the income to the real estate investment trust. What are the benefits of the REITs? REITs means real estate investment trust. Real estate investment trust will offer multiple benefits to its stakeholders, namely developers like investors or a private equity holders and government. The following the benefits is there. Benefit first one is developers improve liquidity and capital raising opportunities. So the first benefit is developers benefits is improve the liquidity and capital raising opportunities. Second one is the private sector, private equity players. Existing opportunity and beneficial for a long-term investors with a limited risk expected. Next, third is the third benefit is retail investors, developers benefit, private equity benefit, and retail investors benefit. Low ticket size of improved transparency in the property investment with the high grade of the safety. Low investment, we get the high grade of the security. Then last, what is the final benefit goes to the government? The government improve the revenue. They get the revenue. These four important are benefits to the REITs, real estate investment trust. Number one, developers benefit. Second one, private equity benefits. Retail investors benefit. And the fourth one is government benefit. This is the 8 marks question. Please note this important question. Next one, infrastructure investment trust. Infrastructure investment. This is the second one. First one is the REITs, real estate investment trust. Then second one is the infrastructure investment trust. INVITS investment trust. It is clear in page number 138. What is the investments? Infrastructure investment trust. It is designed mobilization of funds for the projects like roads, highways, tolls, and power plants, telecom infrastructures. These are examples of the infrastructure investment trust. So this is a construction related, the major projects which are involve the higher generation period are taking the long-term loads like about approximately 5 to 10 years or more than 10 years. So it is related to the infrastructure investment trust. Infrastructure investment trust work like a mutual funds or REITs. They pull a small sum of money from the investors and invest in assets relating to the infrastructure projects. A portion of this cash flow generated by the trust will be distributed to investors in the form of dividend. This is a major important point is infrastructure investment funds, they get the benefit to all equity shareholders. Like if any profit that is distributed among the shareholders, the purpose of the way of dividend. Next is the infrastructure companies are attached with the all types of risks, and this is investment and instrument is suitable for those investors with a heavy risk bearing capacity of the high value of investments. Example, IRBA infrastructure developers launched in the first time in India. That is 2017. Minimum investment during the primary offer is 10 lakhs, lot of size. The secondary market value is 5 lakhs. So this is the infrastructure investment trust introduction. Then types of infrastructure investment trust. There are two types of major, the two types of investment infrastructure investment trust. Number one, completed projects. Second one is the under construction projects. Completed projects means uh, infrastructure have been allowed one and allowed investment mainly completed and revenue generation are generating the infrastructure projects and other the flexible to the investment completed under the construction. While the farmer has to undertake a public offer of its units, the latter has to opt for a private placements units. Both the structures are required to be listed. So in infrastructure investment trust are compulsory listed in the shares. Okay. Next, place in infrastructure investment trust. In a year, essential players are consisting in the four players here, where infrastructure investment trust play of four important persons or key persons is there. One is the sponsor. One is the sponsor. Then second one is the investment manager. Next one is the project manager. Next, fourth one is the trust. One is sponsor, investment manager, and project manager trust. So these are four important uh, persons or players in the this infrastructure investment trust. Next is the risk of investment in the infrastructure investment trust. Infrastructure investment funds are no exemption for risk, and these funds are highly sensitive towards change in the infection and tropic data. There are three different types of risk investment infrastructure investment bonds funds are exposed in the market. Number one is the asset risk, second one is inflation risk, and regulation risk. These three risks are involved in the infrastructure investment funds or trust. Number one, asset risk. Second one, inflation risk means the changes of the prices increasing and decreasing. And regulation risk means it is a change in the rules of the governments, etc. These three important rules involved in the risk investing uh, in infrastructure funds, trust. Then second one, asset risk. What is asset risk? Uh, Infrastructure investment funds are investing in a long-term revenue generating assets such as road projects, and for such type of the assets, a revenue estimate the relatives based on the tropic value. Any decline in the estimated tropic value can have the negative impacts on the revenue of the fund. Next is the inflation of the risk. Higher inflation leads to higher operational uh, cost in the fund. In such case, infrastructure investment funds are uh, increased, like a toll charges, which is linked by the uh, government rules. Next, regulatory risk. Government change with the reference to the taxation and policy issues and infrastructure sectors have the impact on the infrastructure investment funds. These three important risks involved in the risk of investment infrastructure trust. Next is the management of the investment trust. Management of the investment trust. There are several types of the investment trust functioning in the financial markets, and based on the assets classes, investment policies, or management style, a fluctuation of investment trust will be different and unique in their operations. Broadly, investment trust management style can be categorized in two types. One is the active managed trust and passive managed trust. Here, two types of management trust. Actively managed. are trust. Then second one is the passive. So what is the active management trust? These are investment trusts in which a fund manager's activity manages trust by closely tracking the incidents and beat the indices for the generating extra returns and positive returns. These investment trusts always attempt to generate the consistent return to the investors. Next, possibly managed trust. Possibly managed trust replicates the index and it's a holding the generation or generating performance same as the index. This is a possibly managed trust. Next, top-down approach and bottom approach. Here two is there. Find management heavily concerned with the macroeconomic factors and adapt an approach by way of phase-wise analysis of economic factors, industries, factors and company-related factors for the investment decisions or following top-down approaches. Next is the fixed investment trust. Fixed investment trust means these are securities exchange commissions under USA registered United Unit Investment Trust, like a functioning in the financial markets, widely held in the fixed investment trust. Then a typical issues of redeemable securities to the investors, and in future they will back the securities from the investors at a national activities. Next, future of the investment. This is no need. Okay. In this chapter, important for questions are pick చేసుకుంటారు important questions here.
చెప్పండి సార్.
Page number
134.
Page number 134. Yes, 134. A meaning of investment trust.
8 marks సార్. 5 marks.
8 marks. మీకు 8 marks and 12 marks ఉంటాయి కదమ్మా.
అవును సార్.
ఓకేనా? Okay, right. Next, page number 136. Types of investment trust. Page number 136. Types of investment trust.
Sir, 10.4 లేదా సార్? ఇన్వెస్ట్మెంట్ ట్రస్ట్ ఇన్ ఇండియా.
అది నో నీడ్. అది జస్ట్ మామూలుగా చదువుకున్నది కానీ కంపల్సరీ అయితే ఇది ఇంపార్టెంట్. చదువుకోండి. ఎస్ 12 మార్క్స్. ఓకేనా? నెక్స్ట్ పేజ్ నెంబర్ 138. Benefits to the shareholders. Real estate infrastructure investment trust. Page number 138. 4 benefits is there. That is 8 marks. Next, page number 138 again. Infrastructure investment trust is there. That is 12 marks question. Infrastructure investment trust. Okay.
10.6 sir.
Next is the 4 marks is management of investment trust. 4 marks is management of investment trust.
Investment
okay. Next. Okay na. Next. Now going to next chapter, that is, this is also in.
So 10.7 important కాదు sir.
ఏమంటున్నారు?
10.7 ఇంపార్టెంట్ కాదు కదా?
10 పాయింట్స్ కూడా ఇంపార్టెంట్. ఓకే, అర్థం కాదు మీరు అడిగే క్వశ్చన్ నాకు. ఓకే, రైట్. ఓకే, నెక్స్ట్ is the Page number 146, mutual funds. This is new chapter and important chapter also, big chapter. Okay, now, what is the meaning of mutual funds? It is a introduction of the mutual funds. Mutual funds are the very popular and financial products in the Indian capital markets. They perform the role of the financial intermediary and bringing the gap between the demand and supply for the capital and financial market. These are the funds raised by the financial services companies from investors to investment them into the diversification of the portfolios of large companies' equities. So this is the mutual funds key role, and mutual funds are floated in by the public sector firm and the private firms and the foreign firms also. Now, meaning of the mutual funds. A mutual fund is a trust pool, the saving of the number of investors who share the common financial goal. The money is collected invested by the fund manager in different types of securities. The income earned through these instruments and the capital appreciations realized by the schemes are shared by its unit holders in proportion to the number of units owned by them. So this is the meaning of the mutual fund. Mutual fund companies like any other financial products companies, investment a fund in the equity and the debt market based on the objectives of the schemes. The investors can invest in a mutual fund schemes either directly or through a financial intermediate. For both routes are invested in the mutual fund sectors. Now, your net asset value, NAV, net asset value is the market price of a unit of a particular scheme is relation to its net assets. Net assets is equal to total assets minus current liabilities and expenses divided by total number of units. That is net assets value. Net asset value is calculated at the end of every market day after taking into the account the closing market prices of all securities in the portfolio. For selecting a mutual fund scheme and annualized return over the different time of frames in more related to the every day. Next, what are the systematic investment plans? Systematic investment plans means mutual fund companies to increase the reach of these uh, funds, providing many facilities in the area of entry and exit from the scheme for any type of investors, and at any stage of the scheme, contribution of a lump sum money at a time is difficult to the investors. Instead of these, fund houses introduce the concepts like a swap and STP investors and allow to the park their funds in the form of the systematic investment plans, where an increase and contribute the fixed amount into the scheme on monthly or quarterly or half yearly or year basis. As a result, at a different price point, investors can procure the units in the same way, and investors can withdraw from the scheme in a stage-wise manner through a systematic transfer of plans. Next, this is important question. Difference between mutual funds and equity shares. What is the equity shares and mutual funds? Or similarities or differences between the mutual funds and equity shares. Mutual funds, for the first one, mutual fund is a money is pulled from the different investors and invested in the shares and bonds of the several companies. This is mutual fund definition. But equity shares, diversification of funds is not possible to equity shares. Diversification of funds is not possible in equity shares. Next, in mutual funds are managed by professional fund managers and they do adequate research before investing funds in any financial assets. But in equity shares, in case of equity shares, investment research is the sole responsibility of the individual before investing in the equity shares. Next is a third difference is under mutual fund. Mutual funds are sold in the form of the units and unit holders are not connected with the growth of the economy or company. Next year in equity shares, in case of equity shares, investors became the shareholders of the company and based on the performance of the company, investors may get dividend or capital appraisals. Next year, in mutual funds, capital risk is minimized as the fund are diversified into the various companies. But in equity shares, risk is very high as investors directly invest into the stock. In mutual fund, investment in mutual fund is easy compared to equity investment. But in equity shares, investment in equity shares will consume a lot of time and research. Next year, a mutual fund. In case of mutual fund, unit holders don't have any option to change the stock or bonds in the portfolio as they are managed by the fund managers. In equity shares, investors can exit from any stock and buy other stock at any time. They have a freedom in design their own portfolio. Next is in mutual fund to investments in mutual funds, demat accounts is not a compulsory, but in equity shares, to invest in equity shares, a demat account is mandatory. In mutual fund investment, no need of a demat account, but if equity shares lo compulsory, we open the demat account. Next, in demand mutual fund involve charges like exist, loads, and total expenses ratio. But in your equity shares, brokerage charges need to be borne by the investors in equity shares. Next, your mutual fund, it is an indirect way of investment in share markets on behalf of the unit holders and the managers will take a long and short position in the market. But in equity shares, it is a direct entry into the share market. It consists of players like traders and investors. Traders adopt a short-term approach in the share market, while investors adopt a long-term approach in the share market. So this is important question at 12 marks tickets. Next, importance of mutual funds. This is also important question. Importance of the mutual funds. Mutual fund industry across the world has been witnessing an enormous growth in terms of the size of assets under the management. Mutual funds are provided multiple benefits to the investors at a large and contribute to the economic development in terms of the capital formation. The following important points are advantages of the mutual funds. One is the diversification of the benefits. Diversification of benefits means here investment improves like a risk-return portfolio of the portfolio. Small investors may not have amount of the capital that would allow the optimal diversification. This is the first advantage are important. Then second one is the low transaction cost. Low transaction cost. In mutual fund, the transaction of a mutual funds are generally a very large. These large volume attract a lower brokerage commission and other costs as compared to smaller values of the transaction entered into by individual investors and brokers. Next, availability of the various schemes under mutual funds. Mutual funds generally offer a number of schemes to submit the requirement of the investors. The investors can choose between the regular income schemes and the growth schemes, between schemes that investment in the money market and those that investment in the stock markets. Next advantage is professional management. Under mutual fund investment, management of portfolio involves continuous monitoring the various securities and the economic and non-economic variables that may affect the portfolio performance. Next is the liquidity. Liquidity is a portfolio is not always easy. There may be liquidity market for all securities held. In case only a part of a portfolio is required to the liquidated, it may not be possible to sell all the securities forming the part of the portfolio in the same proportion. In the same proportion. Our next advantage is tax benefits. Under mutual funds in India, a dividend received by the investors is a tax-free. The enhance the yield on the mutual funds marginally as compared to income from other investment options. This is also one type of benefit. Next, well-regulated mutual funds. All mutual funds are registered with the SEBI and they function with the provisions of a strict regulation designed to protect the interest of investors. The operation of a mutual fund are regularly monitored by the SEBI, Stock Exchange Board of India. Next important is transparency. Transparency, a regular information on the value of investment in addition to disclosure and the specific investors or investment made by the scheme, the proportion invested in each class of assets and the fund manager investment strategy and outlook the input. Next, flexibility. Mutual fund provide features such as systematic investment plan, like a systematic withdrawal plan. SIP means systematic investment plan. SWP, a systematic withdrawal plan, and dividend reinvestment plan. Through these features are in mutual funds only. So this is also important question. Importance of mutual funds. Okay, right. Next one is types of investments. Mutual funds. Types of mutual funds. There are variety or so many types of mutual fund schemes available in India or investors in the financial market. These schemes are distributed by the mutual fund intermediates to various investors suitable to their financial plan. Mutual fund schemes range from plain products to the complex funds. Broadly, mutual funds schemes are broadly classified in three categories. One is the by structure. First one is the by structure, by investment objective. Next, special schemes. Here, three categories there. What is the first one? First one is scheme classified into the structured mutual fund. Then second one is the investment or funds. Next one is the special schemes. First, under structured open-ended schemes, open-ended scheme, and open-ended scheme fund in that it is available for subscription all through the year. That is open-ended schemes. These do not have a fixed maturity time. Investors can conveniently buy and sell the units of net asset value. This is a open-ended schemes. Next, second one is a closed-ended schemes. Closed-ended scheme funds are financial securities that are related or traded on the stock market. A sponsor, a mutual fund company, or investment dealer will create a trust fund that raise fund through the underwriting to investment in a specific fashion. This is the closed-ended schemes. Next, interval schemes. Interval fund combine the future of the open-ended and closed-ended schemes. They are open for sale or redemption during the predetermined intervals in the net annual value. Then second method is by investment objective. By the structure is the one. Second one is the investment. Under this, growth schemes, the aim of funds to provide the capital appreciations for the medium and long-term loans. Such schemes normally invest in the majority of their crops of the equities. Next is the income schemes. Income streams means the aim of the income funds into provide the regular and streetwise income to investors. Such schemes generally investment in fixed income securities such as bonds, corporate debentures, and government securities and other securities. Next, balanced schemes. The aim of balanced funds is to provide both the growth and the regular income. Uh, Such as schemes periodically distributed a part of their earnings in the investment, both the equity and fixed income securities. Next, the money market schemes. The aim of the money market schemes is provided easy liquidity, presentation of the capital, and moderate the income. These schemes are generally investment in a safer, short-term and instrument such as treasury bills, certificate of deposits, and commercial papers and interbank call money markets, etc. These are the investment objective of the mutual funds. Next, third method is, third category is special schemes. Special schemes. Number one, tax saving scheme. So this is important. These schemes offer the tax rebates to the investors and under specific provision of the Indian income tax law, the government of India is provided some specific rules and regulation for the tax saving schemes according to the Income Tax Act 1961. Next, index schemes. Index schemes means here index fund schemes to replicate the performance of a particular index such as BSE, Sensex, or NSE, etc. These are the index schemes. Okay. Next is the gift funds are gilt. Okay. Next, floating rate of fund. These are debt mutual funds investing about 75 to 100% in the securities, such as bank loans, bonds, and other debt securities that pay a floating rate interest, while the rest in the fixed income securities. So this is a floating rate of funds. Next is the treasure management funds. These funds are very similarly to a liquidity funds and input in the money market securities. They choose the investments or instruction with a tenor up to 364 days. Next, high yield debt funds. High yield debt funds. High yield debt funds means funds seeking the higher investment income by investing in the debt instruments having the lower credit rating and therefore higher risk of the defaults. Next, fixed maturity plans. Fixed maturity plans are possibly managed closed-ended mutual fund schemes in with the portfolio of held in the maturity. Next is the monthly income plans, MIP. MIP means monthly income plans. The primary objective of the monthly income plan is to generate the regular income for the investors for the fulfilling this purpose. These funds invest in a fixed income securities as to make the monthly payment or distribution of the units. Next is the exchange trade funds. Exchange trade funds. And exchange trade funds is an open-ended fund that tracks an index like a index fund, but the trade like a stock on a exchange, just like a share of an individual company. Okay, this is the exchange trade fund. Next, the gold exchange trade funds. Gold exchange trade funds that are meant to track closely the prices of the physical gold. Next, fund of a funds. Fund, FUN, fund of a funds. A fund of funds investment in other funds. Its a portfolio is not made up of the securities, but of the other mutual funds selected to serve a given investment objective. Next is the assured return scheme funds. Assured return schemes are those schemes that assure a specific return to its units holders, irrespective of the performance of the schemes. Next is the aggregate funds. Aggregate funds are the next category which take the advantage of the price difference between cash and future diversification market in the generating the returns. Next is the international funds. International funds investment securities like international around the globe in the foreign market instead of the domestic market. These funds are more value and important also. Next, regional mutual funds. Regional mutual funds confine their investment to a specific geographical area. Usually, these mutual funds which invest inside their own country or local funds are called the regional mutual funds. Next, lifestyle funds. These asset mix of the funds determined by the level of risk and return that's appropriate for the individual sector. Several factors as investors age, like a risk, investment purpose, that the time duration of investment, asset is a mix. Next is the equity shares. Equity shares. Next, equity shares, equity mutual funds. So equity shares, equity schemes and equity mutual fund, primarily investment in the equity shares of a listed companies in the stock market. These listed companies range from the large capable of the markets or stocks. Equity mutual fund schemes can classify it into 5 categories. How many categories? Here, 5 categories. Number 1, based on the market capitalization. Second one is the based on tax treatment. Third one is the based on investment style. Fourth one is the based on the management style. And fifth one is the based on the growth prospectus. What is the first one? It is a large cap funds based on the market capitalization. Large cap funds, mid cap funds, small cap funds, and multi cap funds. Again, 4 subdivisions of the based on the market capitalization. Then second method, one is based on the tax treatment. Here, 2 types of tax subheadings is tax saver and non-tax saver funds. Next is third category, based on investment style. Based on investment style. Number 1, focus equity fund, contra equity fund, sectoral equity fund. These 3 important investment styles. Next one is the based on management style, activity management style and positive management style. Then fifth one is based on growth prospectus, value fund, and growth funds. These are important. 5 schemes are under the equity mutual equity schemes or equity mutual fund schemes. Next, risks involved in the mutual funds. Here also same. So risk means here. So the following are the various types of risk involved in the investors. Understand the why investing in the mutual investments or mutual funds. Number 1 is market risk. What is the first point? This is also important question. So this is market risk. Market means at the time of price of yield at the securities in the particular market, rise or fall down. So this is one negative or risk. Then second one is inflation of risk. Inflation risk is associated with the bond funds and the money market mutual fund. These are fixed rate of interest. Investment rate of interest is there. Next is the credit risk. Credit, it is the risk resulting from uncertainty in the country or other situations. Next, interest rate risk. Changing the rate of interest affect both the equity and bond. It is also one risk. Next, exchange risk. A number of companies generate revenues in a foreign currency and may have the investments or expenses also denominated of the foreign currencies. Next one is investment risk. The sector fund schemes are invested and equity of the selected companies in the particular sectors. Next is factors including the section of mutual funds. So small questions there. Finance for professionals and generals. Yes.
So class over.
2 minutes. 1 minute. Okay, last 1 minute. So factors to be considered in the selection of the mutual funds. Finance professionals and generalists. Journalists are frequently claim that the various funds are attributed as usual devices. Number one is the past performance. Second, asset size. And next, expense ratio, load status, investment style, and risk. Page number 157. This is also important point. Age of the mutual fund schemes. It is 8 marks question. Today is this last chapter important question. Page number 157, 11.7. This is a short bit important. Next, page number 156. Risk involved in the investments. 6 points is there. This is also important. Then right under these side heading, types of mutual fund schemes are also important. This is 12 marks question. Types of mutual fund schemes also important. This is a 12 marks question. Okay, na? Okay, once again, I take the photo one. Right. Okay, ma'am. Okay, now class is over. Right.